So we're going to get started here in a second. First and foremost, thank you so much for carving out some time. We're really excited to go through this edition of WP90X, Family Government Charity, Your Allocation Decision. Michael and I this is a client that we've worked on. We're going to go through an interesting case study. And we've done quite a few cases like this, but this one we've really pulled out all the stops in terms of the different tools and what have you that we have access to. So we're going to go through some housekeeping items first. So in terms of CE, we're going to run approximately 90 minutes, possibly a little bit shorter, and this is going to be 1 credit hour. Make sure that you answer all the required polling questions. So the polling questions are there to ensure that we can prove attendance, so we can make sure that you get credit. And you're not going to be graded on the right or wrong answers. We just ask that you participate in the polls. If you're going to submit questions, please use the Q&A function in your Zoom toolbar, not the chat function. We'll be monitoring that Q&A chat or the Q&A function. And if there are any additional questions regarding technical items or issues with CE credit and what have you, please reach out to Kristen at Kristen, but with 2 I's, at wealthpoint.net. And then at the end, we're going to be sending out a survey in order to comply with NASBA, our audit and our compliance to get the CPE or CE credit. We'll want to make sure that you complete that survey, and we'll get certificates out to you or emailed out to you within 30 days of the completion of this webinar. So we're going to get started with going through the learning objectives. We're going to go through the importance of deep client discovery. This is often something that most of the folks that'll attend these types of webinars will do, but it's we need to go deeper and deeper, almost pull back or peel back the layers of the onion with the client to really get to a point where we can establish some well-defined global macro goals. And then work, one of the things, and this was a prime example, this case study that we're going to go through with you, is learning to really collaborate and share all that great information that comes out of deep discovery with all the members on the planning team, because a lot of times people are surrounded with really incredible intellectual capital and talent. It's just a matter of giving everybody the right information. We're going to go through baseline financial modeling and scenario modeling. I think this is really key and crucial because as we've learned through the years, being able to play things out for people and have people see things based on varying economic conditions, varying income tax, estate tax conditions is really important. But then breaking it down to what's exempt and what's not exempt, and then by beneficiary. So they can see, especially for folks like this, because they're not wanting to over enrich their kids, how can we utilize that modeling to enable them to make some pretty big and difficult decisions, and then summarize the plan and define the implementation schedule. Just a little information about the client that we're going to go through, Tom and Jessica Brown, obviously redacted. They've got a civil construction company. They're doing, when we found them, they were doing about 60 million in revenue. Michael, it's quite a bit above that now,
Yeah,
correct?
closer to 100 to 110. So
With incredible profit margins. We were wondering if they were selling illegal bootleg items out the back door, or when they were doing their earth moving, they must be mining gold, but doing very, very well. They own 70% of the company individually, the couple does, and they had previously gifted and sold 30% of the business to irrevocable trusts for the benefit of their 3 active boys. And there was 10% each to each one of the kids, part gift, part sale. They were looking for a liquidity event and attempting to navigate what to do with the company that they built. They really wanted to hold on to it. And they were seeing the potential for intra-family succession because they had 3 really good quality kids. that were operating in different functions within the business and really working well together. And they even had somebody that they considered to be the leader of the three, which is rare. But they were concerned with their estate planning and the allocation of their assets. The boys already had some of the business interests via the estate planning transfers, the 30% of the business. And they also have three other children, their three daughters, which were not active in the business. And they were really philanthropic focused. They'd like to give back to their church, which is paramount in their eyes, and then also community activities. And they engaged us, and we went through the knowledge baseline process, which is really a mutual opportunity filter, a chance for them to try us on for size and vice versa, but where we went through deep discovery with them and interviewed them, their advisor team, each one of their children, their key employees, and really wanted to figure out what were the common themes and then really get to the point where we could evaluate what their options. And one of the options in terms of the succession planning, which they chose to implement on, is an ESOP strategy. And Michael, maybe you can go through a little bit of that detail.
Yeah, sure. So, we've went through on these WP90X webinars before, kind of what an ESOP is, how it works. As Ryan said, we met when we went with the family group and kind of went through everything of what they were trying to accomplish. They agreed to move forward on an ESOP. A big reason for that was Tom was really, when he was thinking about who he wanted to sell the business to, the only people that came to mind were the people that he worked with every day. And so we went through that process with them. They ultimately agreed and negotiated on a transaction with the ESOP trustee for a purchase price of right around $160 million, partially bank financed. So it was a $61 million bank financing transaction. And then they had a seller carryback note for the remaining amount. And you'll see it in the modeling, but one important note is that the seller debt is subordinated to the bank, so it's second in line to the bank. And as a result, they're only allowed to take interest payments on that seller note while the bank debt is outstanding. Once the bank debt's paid back, then they're able to refinance the seller debt or pay back the seller debt at principal and interest over the remaining years. One other portion of the ESOP transaction were warrants. Those warrants represented effectively stock options, but an ability to monetize a portion of the company at a future fair market value. Those were monetized or going to be monetized upon the earlier of 10 years or the repayment of the transaction debt, whatever comes first. Those warrants represented 17% of the company. And so just as an example, those warrants at the 17% rate, whatever the future value is of the company, they can sell those warrants or monetize them, basically cash them out for a cash payment up to 17% of the equity value of the company at that future date and time. So if the company value grows to be 200 million, 17% of 200 million, that's another $34 million. That would be effectively a second bite at the apple. There's an earnout component as well. As Ryan mentioned, while we were engaged with them for roughly about a year. I think we actually met them about a year ago, right around this time, surprisingly. But through that time period, they were awarded several very large contracts for the work that they do in the civil space. They had a huge growth trajectory, a very significant backlog. And so we also put in place an earnout so that as they recognize that growth over the next couple of years, there would be a corresponding increase in the purchase price as well. And ultimately, the ESOP is a tax-exempt entity, and as a result, the cash flow savings are going to allow them to pay back the debt in a very tax-efficient and hopefully a very timely manner as well.
But we're not here to talk about ESOPs. We're here to talk about zero estate tax planning. But we have our first polling question. Again, just to remind you, please answer the polling question. It's an important part of our ability to offer CE. So if you're interested in getting that, you'll see them pop up. Please answer them, and then we'll move on. And then again, just a reminder for those that joined late, please use the Q&A function. If you have any questions that come up, we'll be monitoring that as we go. So a little information about the client and really those macro goals. So we really wanted to make sure that Tom and Jessica had enough assets to be financially secure during their lifetime. And it was funny, as we were talking to them, they thought they spent $15,000 a month. And the advisor chuckled and said, you might do that in a weekend. But we got to a point where we had agreement that they needed 100,000 a month net after tax, increasing at 3% a year. And then if we were to present value all those future escalating cash flows at 4%, what would we need today in order to do that through their age 110 and that or 105? And that is $38.5 million is what we need in either net after-tax income producing assets. So that could be real estate, it could be stock portfolio. We need to have an equivalent amount of income producing assets. We also needed to make sure that Jessica was financially secure, independent of the future success or failure of the business in the event that Tom predeceased her, because that's her representative. That's who is there, and she trusts that everything's going to be fine so long as Tom's there. And Tom is still very heavily involved in the overall high-level leadership of the business, but we determined that to be 80% of that joint need, or $80,000 a month net after tax, which is about $30.8 million. We also wanted to cap the amount that each of Tom and Jessica's kids received at $10 million in total assets in 2025 dollars, and then index that for inflation. They actually started out at a much higher number. They started out at 20 million per child, and they have 6 children. I failed to mention this, or I think we went through 3 active, 3 inactive children. But they started out at 20 million, and then they just don't want to over enrich the kids. They felt like 10 million was enough. But then when we really pressed them, because these assets are not going to be received a large part until they pass away, which is going to be when the kids are in their late 50s, early 60s. We also carved out a chunk for each one of the grandchildren. And so they have 18 grandchildren. They're contemplating that they're going to have 2 more and get to 20, which is quite the brood. But they wanted to make sure that we had at least 2.5 million per grandchild in a carve-out trust just for grandchildren with that same criteria. And it's important because when we started talking about it, they were like, okay, well, the kids are going to leave the grandkid or their grandkids money, but there was no money for seeding entrepreneurial ventures or buying a first home or doing things like that. And if the kids are at a point where they're relying upon the assets that were left designated for them, they're not going to be making risky investments in their future. And so this 2.5 million per grandchild, again, assuming that we have 20, even though we only have 18 now, was another objective that they really got nailed down. We want to create a 0 estate tax plan and make sure that we create maximum control and flexibility in their estate plan. While they're ready to do some pretty comprehensive planning, they're not ready to do a lot of really extensive gifting and sales strategies and perceived loss of control or access to income, because they're just entering into this lifestyle of having multiple homes and everything else. They've led a very, very simple lifestyle up to this point. But it's funny, as we were going through the discovery process and asking them to describe utopia for us, one of the things that they said, we've always dreamed of having a ranch in Montana. And so, an operating cattle ranch. And so as we went through the process and evaluated the value of the business, we're like, you can do that now. They were thinking it was going to be 20 years from now. Tom Brown is quite the quick decision maker. He decided he was going to do it, and the close date just happened to be one day after the close date of the ESOP, which put a lot of pressure on Michael to get the ESOP closed. But they actually bought the ranch. They bought a new plane so they could travel and shuttle the family back and forth to and from Montana, and they're living their best life. They've described to us many times over that they couldn't be more thankful for us pushing them in certain directions, because it's enabled them to do so much for themselves, first and foremost, and we tend to be hardest and deprive ourselves of things and give to others, especially servant-minded individuals like this, their children, but more importantly, their employees. The ESOP was something where they could really give back to their employees. And even though they've got that earnout in there, they're really happy that all the future successes are going to accrue to the benefit of those folks that have really helped them get to where they're at today. And then we need enough liquidity to facilitate the estate planning objectives and then make sure all the estate planning is properly coordinated with everything else.
Hey, Ryan, just to interject and ask a question for the group, because I know a portion of our presentation is on discovery. Would you mind just giving a quick overview of what the process was like to get this information out of Tom and Jessica? And, because, I mean, these are obviously very detailed goals. They're very, well written. They're very established. But I know talking to entrepreneurs, they don't think this way, right? They don't walk around saying, I want this much for my financial security and defining these things. So just maybe for the group, expand a little bit on the process to get to this point.
Yeah, it's a lot of pivot questions. So asking a question, pivoting, and then a lot of times they don't even want to answer because they feel selfish in focusing on self. And so we're really having to push them to the point where they can establish and then play things out for them in terms of from an estate planning perspective, if it's allocation per child, and talk to them and tell stories about what other clients have done. We've got clients that want to just leave everything to their kids. We've got clients that don't want to leave anything to their kids, want to leave everything to charity, and everything in between. And clients that have already sold their business, clients that have sold some of their business, like these folks with the warrants, and they're still holding on to the other assets because they're still assets, other business assets that they're holding on to. But it's really asking a lot of almost being like a precocious child and continuing to ask question after question to get to the point where you can get them really nailed down. And then having a meeting and confirming those things. And so we have meetings just to confirm objectives and really get them really nailed down because that becomes our North Star as an advisor team. These are the things that all decisions need to be rolled up and held accountable to. And we need to do that not just with us in the room, but with the other professional advisors in the room. It can't just be our discovery process. We want to share that experience, that discovery experience with the other advisors and have them ask questions from their specific discipline as well, or give feedback or input. And it really, I don't know, Michael, if I've answered it the way you hope, but it really produces an incredible result. And we'll go through some baseline financial modeling and what have you here in a second. Michael's going to go through the current situation.
Yeah, perfect. So when we look at just their current situation, and when we define current, we're talking, today is in the sense of post ESOP transaction. We can just see the mix of their different assets. So they have approximately about $43 million liquid between their cash, their investments, marketable securities, and retirement account assets. A little south of $10 million of real estate, and that's net of any mortgages that they currently have. The 62.6 million in other assets, that is primarily made up of both the warrants as well as their portion of the seller carryback debt from the initial ESOP transaction. They have a small amount of life insurance. That's just the cash value on the policies that they currently have in force. And then they have some other business assets. Those business entities, they own some of the commercial real estate that the company operates out of that's held in an LLC. They also own the equipment leasing company that leases the hard assets back to the company to do the civil contracting work. They also have some other development deals, and they've invested in a few smaller kind of business investments over the years. When we do our modeling, which we'll show in just a second, we're basically adjusting the investments accounts or that cash and securities bucket each year by their annual spend, and then adjusting it based off of the growth of the investments and their net after-tax cash flows from all sources. And then the warrant value, for those of you that have not seen warrants before in an ESOP transaction, the value today of the warrants is very nominal because we issue them immediately post-transaction, and then they grow in value as debt gets repaid and as the company value appreciates over time. So we're assuming that those are going to be monetized 12 years from today. It may happen earlier, just depends on how quickly they pay off the transaction debt. So when we look at their core capital, or really their financial security, what this shows is the red line here is their core capital need. As Ryan mentioned earlier, that's the $100,000 per month. We're growing that at an inflation rate, present valuing all those future tomorrows to see what is that core capital need. That's the red line, approximately $38.5 million today. And then we compare that to the solid blue line and this dashed green line, which really represents their net worth for financial security. So we've discounted certain asset classes to account for either taxes that would be due upon liquidation or discounted because of the volatility of the actual value of those assets, real estate, some of the business assets they have, if good economic times or down economic times, that may affect the actual value of those. And then the green line represents their liquid assets. And so that would be their cash and securities that they currently have, as well as the ESOP carryback note associated with the transaction. And so really
income producing assets.
Yeah, income producing assets, exactly. And so we can just see there over time, how does that change? Obviously, today they're well above their financial security line. And then from there, we can see the liquid assets as well. The spike here out in 10 or 12 years is just the warrants that are being paid off from that time period.
Same thing with spousal security. We're above that line. And again, Michael, if you go back one slide, that delta between the blue line and the red line is really all excess wealth. And so we have a choice with that. We can either choose to increase our lifestyle, spend more. We can get more to our kids, or we can give it to charity, because all that excess wealth has a partner in it. An equity partner that's participating in 40% of all the upside, and that's the IRS ultimately via estate taxes. So then that's really a choice of we have to hold on to, in this case, at least $40 million of assets or income producing assets for them at all times. And we probably want to gross that up a little bit in order to be safe. But we can go on now to the estate tax calculation.
Yep. And so when we look at the estate tax calculation, again, we just have the makeup of their assets as I just went through. We've made assumptions and projections here for cash flows, growth rates, net after tax or tax assumptions that we worked on with their CPA in order to make projections over this effectively 20-year period based on their assets and those growth rates. So again, we're starting at approximately 140 million, growing those assets to almost 300 million over that 20-year time frame. When we look at the estate tax calculation, we have factored in some or a discount here, relatively conservative discount, but a discount of 20% on certain assets. Those are for things like lack of marketability, minority interest, discounts on certain assets. And then when we factor in their discounted net worth, we're subtracting out their estate tax exemption. Again, they have done some gifting already, as Ryan talked about, with the transfers of the 30% in total of the business assets previously. So we have a taxable estate today of about 94.5 million, and then subsequently an estate tax of almost $38 million. And as you can see over time, that is just continuing to grow on a go-forward basis. We have updated the estate tax exemption to reflect the recent change as well in estate tax regulation.
They've used about 2 million of their exemptions so far. Initially about 1 million when they did the gifts and sales to the defective trust. And then post-transaction, they paid off some of the girls' homes to get more assets to them as well. One of the things that we've failed to mention when we were going through the fact pattern, though, is they were really viewing the original 10% the gifts and sales to the boys as being their sweat equity, and so they wanted to leave that 10 million that we had mentioned in 2025 dollars, in addition to what was already there in terms of the value realization that they would get as a result of the ESOP transaction. And so we really wrestled with this. This was a big issue, and especially for mom and dad, because they wanted to make sure that they rewarded the boys for the work that they had done and the dedication and a lot of years of possibly below market salary because they were, kids of the owner. But this table currently just represents what's the allocation currently if we do nothing. What's the allocation per beneficiary? And so it's about $16.9 million for each one of the girls. Again, if we leave the balance of the estate equally, and that's what they had chosen to do, and there's a difference between what's equal and what's fair, and they determined that this was what their definition of fair was. Each one of the boys also has, you can see 16.1 million, Michael, if you can point to it, of equity that is there as a result of the ESOP sale, part cash and then part seller carry note, and they also have warrants, correct, Michael?
Correct. Yep.
And so their pro rata share of the warrants. So the boys are about double. If we go to the next page, we also break it down based on what's exempt, what's non-exempt, what's going to, again, family, government, and charity. So the government's getting almost $38 million. We've got about 74 million of GST exempt assets based on what's already been done. The lion's share of that 74 million is already effectively the boys. And so that's where the big chunk of that is. The non-exempt assets are so that it'll be taxed at the next generation. And remember, we've got 18 currently and going to have another couple of grandchildren potentially. But it's just under 76 million. They've got actually it's a donor advised fund, which they're in the process of establishing a family foundation now. But their total legacy assets, so those are assets that are going to the kids or charity, is just under 152 million. And so when we get into this, if you can see, we're leaving the kids or the family about 150 million with the current planning. So that's the combination of that 74 and 76 million dollars. The next, Michael, if you want to go through this and.
Sure.
Yep.
Yeah. So, when we look at it as we kind of set the credible baseline and then talk about some areas of concern, and we hit on the first one already, just the estate tax, right? Their current situation, there's a, fairly significant estate tax amount today and continuing as their assets appreciate, continuing to be an increasing estate tax need as we project forward. I think the other two that are significant though is the allocation of assets. So as Ryan talked about through the discovery that we did, we really needed to define what that allocation was going to be in terms of both G2 and G3. G2 meaning their 6 kids today, the 3 boys active, the 3 girls that are inactive, and then G3 meaning the 18 and projected to be 20 grandkids at that generation. And then also just the allocation on the charitable amount. When we look at our current planning, there is no allocation to charity today. They just have what they've already gifted. So if something were to happen to them yesterday, there would be no charitable fulfillment based on the current estate plan. And there's also no current allocation to grandkids either in the current planning. And that's something that they obviously, as Ryan went through the macro goals, they've decided they want to maximize their net worth for charity. They want to maximize the net worth for G2 and G3. And so we need to make that update. And then we also wanted just to look at the assets of during life versus at their passing. So what is available and what can be utilized by either G2 or G3 while Tom and Jessica are alive, so they can see the benefit of the wealth that they've transferred and what that means, whether that's buying homes, whether that's starting businesses, whether that's educational things, whatever that might be, versus what's available at their passing. And so we'll talk about that. We'll have a slide that'll go through that, but I think that's an important thing where, as Tom and Jessica really shared with us, they've spent their whole life building this net worth. Now that they have it, they really want to see their kids and ultimately their grandkids use it, right, for good, use it for something in the community, in the church, in their family.
Except they don't want to see them use too much.
Correct.
And so there's
Yes.
this balance. And so when we're talking about this $10 million goal, they think about it as 10 million today. And so again, doing the modeling, and you'll see this play out as we go through the scenario modeling and the specific by beneficiary, exempt, non-exempt, everything else, really helped them be able to make some fairly difficult decisions. So we'll get into that in a second, but we'll go through the planning itself. So the first step is to really look at, we find, especially with entrepreneurs, they like to see the bottom line up front. So tell me why I should tune into the material. So we go, this is the current, go through, this is the current situation. And if we go through the proposed planning that we're about to discuss, the results are on the right. So we end up with about 110 million going to the kids and about, I think it's 142 million going to the foundation. So all legacy assets now. Zero going to the government and 100% going to either charity, philanthropic, which is going to be split probably 50, 60% to the church that they're committed to, and then the other half or less going to causes that are generated by the family group and what have you. But all those assets that are going to the family are now GST exempt. So all exempt from future taxation at future generations and protected from creditors, divorcing spouses, and potential estate taxes. And now we've got about 60% of the assets going to the family and 40%, actually it's flip-flopped. We've got 60% going to, and this is a result of some of the changes that they made in their planning, but we've got more going to the, or yeah, 60 going to the family, pardon me, and 40 going to the charity. Okay. So in terms of the steps, first thing that we need to do is create a mechanism that's completely flexible. And so what we decided is to make sure that the revocable trust, so if they wanted to increase and go from 10 to 15 or to 20, or maybe give more to the girls and have the boys get just 10 as their allocation in today's dollars, and the girls maybe go to 15, they'll have the flexibility to do that. Right now, they're just wanting 10 million per child equally, excluding the sweat equity assets, if you will, of the original gifts. And so what the trustee of the revocable trust is instructed to do is to look at all the other assets outside of the estate first. And if those assets meet or exceed the goal of 10 million in 2025 dollars, and we're targeting to hit that goal in 15 years, because we need some time for some estate planning transactions and what have you or strategies to mature. And they have to factor in all the beneficial interests in those assets first. And then if they meet those or exceed those, then everything gets dumped over into the family foundation. And the remaining assets are going to be there to benefit the causes that are near and dear to the family's hearts. Michael, I don't know if there's anything you want to expand on this.
I was actually, I have one thing that I would like you to share, but I was going to just go to the next question or the next polling question. So we'll go ahead and launch that for the group. Make sure you guys answer it, as Ryan mentioned, so that we can allocate CE credit. While they're answering that, Ryan, though, I was going to just ask you, you want to maybe explain Tom's conversation that we had when we went through this initially, and he asked if he should pay some estate tax?
Yeah, he said, this country has been wonderful to me, and should we just consider paying a state tax? And both us, but primarily the attorney, said the estate tax in terms of percentage of revenue of the U.S. government is a pimple on a bull's behind, and you paid a lot in terms of income tax, and you'll continue to pay income tax for the rest of your life. And so if we look at that, there's no need to feel an obligation. You're paying more than your fair share. And he thought about it for a little bit, and he said, you know what, you're right. And especially as we've gone through and evaluated a lot of the strategies, he said, I would rather a certain percentage of their net worth is going to be social capital, whether they like it or not. It's either going to go through a bureaucratic system that has a lot of waste, potential fraud and inefficiencies, or it can go through a mechanism that the family can control. So.
Perfect.
You want to go?
Sure. Yeah. So just as far as kind of the steps of the process for the proposed planning, first step is a transfer of community property or a transmutation of assets. The assets that we're really going to focus on, obviously, we want them to be very highly appreciating assets. So we're primarily going to focus on the warrants and then a portion of the ESOP note receivable. Again, they have approximately $27 million of estate tax exemption available today. Their ESOP note balance and the warrants are valued at about 65 million. And so we're not gonna be able to transfer all of that or utilize their gift exemption or estate tax exemption for all of it, but we're going to focus on as much of it as we can in order to transfer out of their taxable estate today. By doing that, we're really going to create different assets or different trusts. We're going to focus on a spousal lifetime access trust, and we're also going to focus on a descendants trust. The first one here is the Jessica slat, where Tom is going to gift a portion of his sole and separate assets to this slat, which Jessica is going to have a beneficial interest in. Subsequent to Jessica, the kids will also have a beneficial interest in that slat as well. And we're going to be GST exempt. Again, we're going to use the warrants and a portion of the ESOP note in order to make this transfer. One comment, and you'll see it as kind of a future planning, but in our modeling or what we're showing today, we're really just focused on utilizing the available exemption. They can always do additional planning if they wanted to through the use of defective trust sales or other types of wealth transfer strategies. But I think at this point, we want to get them into a spot where they've transferred the assets they need to, check the boxes, if you will, for what's going to the kids and what's ultimately going to the charity or philanthropic causes. But again, they could do additional planning if they wanted to in the future.
But their primary concern was just not overdoing it. And because they don't know how their life is going, are they going to expand the ranch? Are they going to do other things that are going to require that capital? And while they could do it with assets that were transferred out of the estate, they just wanted to hold on to things for now. And so help us achieve these objectives, but maintain control and flexibility over the assets. The next step is to create a descendants trust for the benefit of the kids. And so this is for the kids and grandkids. So we used all of Tom's exemption plus and then we still have Jessica's exemption. So Jessica is going to use her exemption to gift to a trust just for the benefit of the kids. So no non-reciprocal slat planning. These people have more than enough net worth. We can give assets away, and even the slat for the benefit of Jessica, we've really gone into this with the idea that this is the last resort for her. So even though she has access to it and will have an income interest in it, those are last resort assets. So because they're totally creditor protected outside of the taxable estate. But this trust is going to be, again, just for the kids and grandkids. It's going to be GST exempt. We're going to use it. We're going to be gifting primarily the ESOP seller carry note, which again, I might say that we're anticipating somewhere between a 15 and a 20% discount because it is subordinated to bank debt. It is a below market interest rate because this is really junior debt. Could warrant an interest rate of 10 to 15%, depending upon your thought process around that. But we're going to use some of that cash flow to buy some survivorship life insurance, which is going to immediately explode the value of the descendants trust in the event that both of them pass away, because life insurance is effectively just a certain event at an uncertain time. We don't know when they're going to pass away, but we know that this is going to be there. And you might ask, why 55 million? It was a mathematical equation. So we went again, essentially simulated the process that the trustee will have to go through, and we'll go through that in a second, to really back in and essentially do a goal seek. What do we need to have there in additional assets in order to accomplish that objective? So We're going to have a little bit of a cash gift up front, and then the carrying costs are going to be covered by the cash flow from the note from that point forward, which is going to be years 2 through 19. And then all the excess cash flow is going to accrue to the benefit to the kids. And we'll go through the actual trust balance sheets that we have the accounting for and the cash flows at the tail end of this presentation. So if they were to pass away, the death benefit gets paid to the descendants trust, and then we're going to buy assets out of the estate. Remember, they want to maintain the continuity of these business assets, some of which are buildings, some of which is the equipment leasing company. And so we need cash to be able to buy those businesses out to maintain that continuity, because the boys are going to still stay engaged and whether still have their warrants and everything else. And a charity, a qualified charity, is not going to want those assets, and in some cases cannot hold them for, what is it, longer than 5 years, Michael, due to UBIT related issues. And so we've got cash in there. It's going to buy those assets out of the estate, and it's going to replace the illiquid assets with liquid assets that the charities can have, and it's going to maintain that continuity. And then the assets are going to be allocated amongst the beneficiaries based on the rules that they've established in that revocable living trust. So if we go on to the next step and really look at, or we've got the family foundation, can't forget about that. They're going to fund it initially. We've got $2 million in the DAF, but they're going to fund the family foundation this year with somewhere between 3 and 5 million. They're still making that decision, and it's actually being formed. But I would guess it to be probably $4 million, $3 to $4 million this year, and we'll get that tax deduction. But then they're going to continue to make gifts to the foundation over time. This is not a one and done gift to establish it and then let it sit there and be dormant for a long period of time. They'll be funding the foundation and utilizing their CPA and other advisors to determine what's the proper amount to do. But one of the things that we talked about with the foundation is that it's really important to establish this during lifetime. We see lots of estate plans where it's a testamentary bequest to a foundation to achieve the result of the zero estate tax plan. And the fantasy is that if we do that, then that's going to be the family glue that holds everybody together after mom and dad aren't here. That's a great idea, but if they don't practice doing that while mom and dad are on the same side of the grass, it won't be successful later on, because everybody's older, everybody's got their own ideas on how things should be run. They need to learn how to run the foundation and work together during lifetime. Otherwise, it has a very, very low probability of success. And so we want to start getting them to understand, because this is going to be a grant giving foundation, what that process looks like, and get the experience over the next 10, 15, 20, 30 years of working together as this foundation continues to grow and grow from mom and dad's contributions. Michael?
Yeah, so when we look at the total, the end results, if you will, of the planning, obviously we've revised their revocable trusts. We've established the 2 new irrevocable trusts in the SLAT and the Descendants Trust, and then established or refined the family foundation. By utilizing that formulaic structure, as we've talked about, that really accomplishes their 3 primary goals. 1, allocating the right amount of assets to the kids. 2, avoiding any estate taxes, and then 3, creating a very large charitable component of their overall wealth and wealth planning. As a result, 100% of the assets now become GST exempt. So we've not only done great planning for the next gen, but we've done great planning for all future generations on a go-forward basis in terms of those assets that are being passed down from G1 to G2 to G3 and so on. And we've also, had a substantial increase in the amount of legacy assets for the family group. You can see just, by doing some of these planning moves and moving assets around and acquiring liquidity, we are substantially increasing their legacy, which is exactly what they wanted to do. And I think that's the really, rewarding part of this case and kind of the work that we do is it's not just about moving more money around and enriching the next gen, but it's also about accomplishing what their family wants to accomplish. And when we were talking with them about what's the dollar amount and how much do the kids get and all of that, it was just, you could tell how proud they were to be able to put a plan in place that's going to reward their kids, reward their grandkids during life and at death. And it just results in a really great wealth transfer strategy for them.
And the significant charitable impact. I think that's the big thing. So if they can benefit their kids, their other family, the employees, and their extended family, the church, and other causes. But we've increased it. If you remember that number that I quoted, we had between the exempt and non-exempt assets about 150 plus the 2 million in charitable assets. That's that 152. We went from 152 to 242, so a $90 million increase today. And over time, it goes from 334 in 20 years from now to 548. So over $220 million more in legacy assets as we go forward. And so, Michael, let's go through some of the modeling in terms of what that looks like. The first thing is just the estate tax analysis. So we show their net worth after the planning is about 106 million, and today 100% of that, because we've achieved that outcome, is going to be going into the foundation. And then as we move forward, we've got a little bit lower going to the foundation because we factor in the increases, the inflationary increases of the increased exemption equivalent that is there. And so we maintain a zero estate tax plan all the way through. More importantly, as we look at the kids in terms of breakdown by beneficiary, our goal was 10 million per child for 6 children. So it starts out at 60 million. And again, remember that we wanted to get to that place by 2040, so 15 years from now. And so if we increase that 60 million by 3% a year, that's going to equal about 1.5 times the number, which is just under $93.5 million for the children. The grandchildren, we needed 2.5 million per grandchild. And again, assuming that we're going to have 2 more, that's 20. So that's 50 million for the grandchildren. And again, big reason, if I've got the kids that don't receive the lion's share of this money until their late 50s, early 60s, now they're really relying on it for current income. Am I going to be able to invest or freely do things for the grandchildren during their lifetime? And the answer is probably no. It's going to be waiting for mom and dad to pass away. So this carve-out trust really for the grands, as they call them, is really, really important to them. And so the total need, again, is 110 going up. And then net to heirs based on the planning, the current planning is at $86.3 million. So we're under $23.6 million today, but you'll see that go away over a period of time, and they were completely comfortable with it. And then again, we're going to break this down by beneficiary during life and at death here in a second. But we've got essentially, when we look at what's going to the kids in 2040, we've got about actually a little less than what we had before. And we've eliminated the government, and we've added a huge philanthropic component, which we'll go through here in a second. But each one of the girls will be at about $7.8 million. So you can see that's the difference or delta. We've got 2.15 million that they're shy, which they're completely fine with if something were to happen to both of them today. But they eventually get to that target number of 15.579. And then the boys also have the irrevocable trust that has the business interest in it that they're benefiting from. And so the grandkids today, though, end up with about $1.9 million, and then eventually get to their target goal of $3.9 million once we get to 2040, or our target year of 15 years. And that was, again, another thing. We could do it today, but if we did it today, it would require a lot of insurance. And we knew that the probability, if you look at their joint life expectancy, the probability of both of them passing away in the next 15 years is pretty low. And when we looked at the relative numbers, and we looked at all of this with them, we looked at the relative numbers. We really hit that year, that 15th year, which will put them at about 78, Michael, I think.
Yeah, 77, 78. Yep.
70, yeah. And so if they got there by that point, they would be in good shape. So this put them in a good spot, and they were able to accomplish their goals. But more importantly, if we go to the allocation on the next page, 100% of the assets that are going to the kids and grandkids are now GST exempt. So we've got 134.5 million going up. And then the balance is going to the foundation. So 108 million, again, increasing over time. So that's that 242 today, that just under 243 million. That is the total legacy assets, again, between the family and charity, all of which is GST exempt. And then in 2045, we end up with just over $500 million, but huge amount going to the charity. We've got just under $250 million going to the charity at that point in time. This really made them smile. But then the other thing that they needed to see was, what's the breakdown of those assets between what they're going to get during lifetime and what they will get at death. And so if we look at that during lifetime, maybe Michael, you can go through this in terms of the breakdown, but G2 is not getting to that $10 million number immediately. They're only at $2.9 million during lifetime. A lot of this is happening at death, the realization, and they eventually get to $10.6 million in 15 years, still way shy of the goal of 15.579, but we're not over enriching either the grandkids or the kids along the way. They don't reach that mark until they both pass away. So
Right.
maybe you can
Yeah.
talk about what you did here.
Sure. Yeah. So effectively, we just looked at kind of the net to heirs, if you will, from a balance sheet perspective of assets, either assets that have been gifted and are now held in the irrevocable trust, or assets that are still held inside the estate, but we're going to use future increases in the estate tax exemption to allocate those. But as Ryan alluded to, and not minimizing any amount of money, but relative to the goal, we're not at the goal during Tom and Jessica's life, right? There's not enough assets that have been transferred or are going to be allocated to G2 or to G3 to achieve those metrics of the 10 million per kid for G2 or the 2.5 million per child for G3 today while they're living. And I think that really was in alignment with what Tom and Jessica were asking, or what they were really wanting, which was to not over enrich them over the next 10, 15, 20 years, or longer while we're living. And so that's really the allocation of the assets there. When we then look at upon their passing, it's the exact same numbers as the ones during life, except with this addition of the survivorship life insurance, approximately 54, 55 million of coverage. And then we can see how that then increases the amount of assets and then eventually aligns with the projected goal of that 15-year target, getting effectively each member of G2 15.5 million, each member of G3 almost $3.9 million, and accomplishes it all, again, GST exempt assets, with the remaining amount, however big that amount is, being allocated to charitable causes, to the foundation or the church, or whatever that decision is.
And remember that 15.6 million and the 3.9, that's really just 10 million and 2.5 in today's dollars, indexed at 3% per year. And again, all of this will be governed inside of the revocable trust. It will look to all the other assets. And just with that gift to the descendants trust using Jessica's remaining exemption, we'll have more than enough cash flow to fund the insurance carrying cost, and then have a lot of excess cash flow, which we can go through here in a second. But again, just reiterating, that was this was the slide that we went through earlier, the current situation versus the proposed planning. We really get to a point where we've got 60% of the Brown family assets going to the foundation, 40% the Brown family 60%, and then 40% going to the family foundation. And the big thing is it really did what they really craved. They said they just wanted things to be as simple as possible. We talked about doing larger defective trust sales and gifts and other charitable strategies and testamentary lead trusts and all kinds of other things with this family group. And really, when we started to go through those strategies, they were too much, and we just got to the point where we just want to hold on to our as much as we can to anticipate how life may change in terms of our life and lifestyle, control the assets, make sure that we get the assets to the kids in a really responsible manner, and do as much for charity, and keep it simple. Now we've got 4 entities. We've got the revocable trust, we've got the descendants trust, the SLAT, and the family foundation. Obviously, they have other entities. They've got lots of complexity in their lives. They've got LLCs for the buildings they own. They've got the equipment leasing company. They've got other entities. They've already got a DAF. There's a lot going on for them, layering on a whole bunch of additional complexity, especially as they're just entering into this new chapter of their life, was not desired. Again, at post planning, we need to do that check and see are they okay and are their kids okay, because we've shifted assets and we're still well above the lines in terms of financial security or core capital and spousal security. And if we keep moving forward, we've got some of the balance sheets, which are interesting as well.
Yep. Yeah, we'll get to that. We'll have our last polling question that'll come up right now.
You want to
and
go
so you
through
guys-
the planning considerations first?
Sure. Yeah. Yeah. So we
So,
just. Oh, go ahead, Ryan.
no, go ahead.
I would just say we just have our next steps. Obviously, that we're talking about with the family group, continuing to make, evaluating the planning, and then obviously becoming the implementation process, if you will, to get all of the documents drafted, the new trust, the transmutation agreements, amending the current revocable trust with the formulaic clauses. Go through the process of obtaining valuations for the gifted assets, establishing the foundation, and then obviously making the gift and filing the gift tax return. We also were just putting on there some future planning. There's some additional strategies that they could consider. We've touched on some of these throughout the presentation, either some additional charitable strategies, future sales to defective grantor trusts, potentially maybe private placement life insurance. But I think Ryan actually hit on a really good point when they talked about simplicity. One of the things that Tom and Jessica have always shared with us is they want time. They want time back to go do the things that they want to do, which really is a different way of saying they don't want to have to do annual estate planning work, right? Additional trust, additional gifts, additional estate planning conversations. I think they really want to focus on making the right strategies and implementing on them today. And it's a little bit of let's set up the plan and then let us go live the rest of our lives, right? And not have to be overly concerned with, do we need to update our estate plan frequently, or those things. And so while we have some future planning considerations, I think it's yet to be seen of how many will actually consider or be evaluated or implemented on. So
His exact words were, I want to focus on teaching my grandchild to go do backcasting in the river. They bought a ranch with a significant amount of riverfront in Montana. And so he just wants his time back. He wants to focus on that next chapter and be present because they've really ground their butts off in developing this business from absolutely nothing. If we continue on, in terms of the balance sheet, we wanted to take a look and see what does it look like from the stuff inside of Tom and Jessica's estate. So this is the Rev Trust. So what does that look like in terms of their cash flows? So do they have enough? And so if we look at all of their inflows and their outflows, so their lifestyle expenses and income taxes, they're at about 2.4 million in net positive cash flow. So the desire to do some $500,000 to $1 million contributions to the foundation is still preserved. They're okay in terms of their ability to do it. And this does not include the cash flows that are in the slat. And so that are still accessible to Jessica. So they're in good shape. And then their balance sheet going forward, they've still got plenty of assets that they can hold on to and could potentially do those future planning considerations, maybe doing a large sale to the Descendants Trust in return for a promissory note or other strategies that may be available to them. But primarily, I would say another sale is something that's possible, and additional gifts to charity are probably something that will happen, but not a lot. Just to echo Michael's point, I don't think a lot more. If we can utilize the structure and the strategies that are already implemented, that is something that's really desirable. In terms of outside of the estate, we have the slat. And so we've got slat cash flows. They're going to be getting the ESOP interest payments and then eventually some principal payments. And you'll see a big spike from 2030 to 2035 and 2040. That's really the repayment of that promissory note. And then also the growth in the investments. And is there some we don't have we have warrants in here. There's the warrant realization as well that gets realized over time. And so you'll see the warrants peaking out at about $22 million. They get exercised or converted into cash, and we end up with a significant amount of cash and securities outside of the estate and the slat by 2040. In terms of the Descendants Trust, again, we've got that the ESOP note interest of 974,000, so interest only, and then eventually the payoff of the amount that was gifted to the trust. And then we've got cash outflows in terms of the insurance carrying costs. So it's about $450,000 annually for 20 years is what's going to be required to fund the insurance. And then it's fully funded after that. But that's buying us the 54 million. It actually grows to a pretty substantially higher number than that at life expectancy, but it's right around for the first 20 years, right around 54 million. So we've got positive net cash flow in the Descendants Trust. So if we want to use it for different things during lifetime, we can. And then the balance sheet, though, is pretty substantial as well. And a lot of that, again, the lion's share is the insurance death benefit. But we still, even at that 2040 mark, we've got just under 30 million and eventually $34 million of assets and investment assets, liquid assets in 2045. So we're going to kind of wrap up our part of the presentation. Again, reminder, the Q&A function at the bottom of your Zoom toolbar. Please feel free to ask us any questions. But one thing that I'll tell you is the best part about these types of engagements is the ability to collaborate with all of you. And so not just collaborating on the plan design and the implementation, but more importantly, collaborating on the discovery process. If you really boil this down in terms of working with these types of family groups, it's really truly about deep discovery. So really getting them committed and emotionally anchored to those desired outcomes, because then everything else gets easier. But even when we got them committed to, they wanted to do 20 million per child and they weren't even thinking about the grandchildren, that evolved. And that evolved into, we really don't want to do 20. 20 is too much. Let's do 10. And then we said, well, what about the grandchildren, and talked about that. And then that developed into the carve-out trust for the potentially 20 grandchildren. So it's about that deep discovery and doing it, that joint deep discovery with the advisor team, reconfirming and really getting nailed down on those objectives. And then the next step is to brainstorm the ideas with the planning team, which is always incredibly fun. We geek out on that and really beat it up and really figure out what makes the most sense to eventually present to the client, again, with everything being rolled up and held accountable to those macro goals that we've all agreed upon, most notably the client. and then going through a trial presentation with a client and letting them feel it and try it on for size. And again, showing it broken down by beneficiary, by exempt versus non-exempt. And then eventually getting agreement and moving forward and implementing on a plan that really is unique and specific to that one family group. And I couldn't do this without my the brains of the operation and my partner in crime, Mr. Michael Kenneth. He's on my right. I don't know if he's on your right on the screen, but just incredible work to be able to kind of make whatever crazy cockamamie things that we come up with come to fruition, and then to be able to prove it out. And not just prove it out under static conditions, we're able to massage those things. So what if the company grows at X rate versus Y rate? What if we don't get a warrant value realization, that it's going to be a lot lower, or it's a lot lower than we originally projected? What if we have an acceleration of the ESOP debt payment? What does that look like? Which is going to accelerate a lot of other things. So there's all these different scenarios that we can allow those clients to go, what if this happens? And we're able to make that adjustment on the fly and be able to show the ripple effect through the entire plan. And it's just incredibly helpful for people to make really big, complex decisions if they got the raw data to do it. So, Michael, and anything that you would add?
No, I am in complete agreement with everything that you just said. I think as planners or as advisors, our job is not just to come up with great ideas, but to help clients implement on those great ideas. I think we've all probably all, even all of our attendees on this call, have had times where you've had these great ideas and great conversations with clients, and then 6 months later or 6 years later, they haven't done anything, right? They haven't implemented. And the area that I think why, or I should say why clients have not, is because they're still uncertain. They can't see the future outcomes. And so it's instrumental to have great planning concepts, but also the ability to show them, numerically on a what if scenarios, because that's that high net worth individual's life, right? And what they've built. And so I think being able to show that, stress test it, show the ripple effect, and also I think having the flexibility to change things, because we know that something is going to change, right? So as you were just going through those what if scenarios, one of the things that we had talked about was, what if the value of the company doesn't grow as fast? What if it takes longer to pay off the debt? What if the warrants aren't worth as much based on our modeling and our projections? That's where we could do a defective trust sale or those types of things to still hit their objectives, right? Take assets outside of their or from their taxable estate, sell them outside of the estate to hit that 10 million, goal each kid for G2, 2.5 million goal for each G3. So it's just creating a plan based on a set of assumptions, but having the flexibility to do things to ultimately achieve that goal in good times or bad times, right?
I think another key component, we're momentum junkies, especially me. I'm a huge momentum junkie. So getting everybody's agreement of what's the desired outcome from this meeting. So establishing a goal, and then establishing a goal for the next step. And then once we get to the end of the meeting, if we've accomplished the goal for that meeting, we've already got commitment to go to the next step. And what ends up happening is we present like a fabulous plan. Life happens, they go back. If we don't continue to schedule the next meeting or the next outcome that we desire to or we seek to achieve, then we have to remanufacture that momentum all over again, get them recommitted to the process and going. And so it's really, really important to collaborate with all members of the advisory team surrounding a client and get everybody on board to commit to some deadlines and some specific goals for each meeting, and then also maybe 2, 3 steps forward, so that they can always see the process and be committed to that process. So again, we're happy to. We'd love to collaborate with you, or if you want to use this as a sounding board or as just a brainstorm, a client fact pattern, we're happy to do that. But please visit our website at www.wealthpoint.net and feel free to reach out to Michael or myself. This will be available on recording, so please share it with a colleague if you think that it might be valuable. We're happy to do a private briefing if you think that this would be good for your firm and shared with other colleagues. But again, on behalf of WealthPoint and specifically Michael and I, thank you so much for carving out time in your morning, especially those of you in the tax business coming right off of the deadline, the September 15th deadline. We appreciate your time, and we always appreciate your support and look forward to the possibility of collaborating with you in the future. Thank you.
Thanks, everybody.